welcome to mywealth.com. I'm Bob O'Brien. I'm one of the senior instructors with the courses. Welcome to the blog for the day. Is it time to buy banks with mark-to-market behind them? Now, the Financial Accounting Standards Board yesterday, said that they would ease up mark-to-market restrictions. And for those of you that I've written a couple of articles on this, so make sure you check out the written blog and refer back to those articles, because it's really important that you have a good understanding of this, not just for investing, but also for your own personal finances. And that's what both my other articles were really about, because how you account for your own assets is more subjective than most people think. And it's really important that you have a flavor for that and a real idea. So you don't fall into the trap of thinking that you're a lot wealthier than you really are. But in regards to mark-to-market, all it is basically how the banks are forced to account for the mortgages that they have. And what they're forced to do, they're forced to mark, like with a pencil, mark in their accounting ledger what the value is, only based upon what they can get for it in the marketplace. Okay, so it's only based upon what they can get for it in the marketplace, regardless of what the market's doing. If the market has gone crazy, they still have to account for it there. And that's been really the controversy surrounding mark-to-market, is that people said that this isn't fair. Right now, there's a lot of things going on with some of these mortgages and so forth, where some of the mortgages are good, some of the mortgages are bad, and that's really where the controversy comes in.
As always, make certain that you check out the written blog at www.mywealth.com/blog. Okay, mark-to-market, in a nutshell, is just a stricter form of accounting. And that's really all it is. It's just, valuing an asset, probably erring on the side of valuing it at less as opposed to more. Now, so just to get a clearer picture, imagine that you have a car that you've owned for a long period of time, say 8 or 9 years, and this car has just been great. It's never broke down. It's been awesome. But you are getting, you do want to sell the car. You want to move on. You're sick of the car and so forth. When you go to sell it in the secondary market, it may not be worth as much in the market as it is to you, because it's just going to be lumped in with all the other cars that are like that, even though that this car was great, it's never given you a problem, and so forth. And that's really what mark-to-market is like. And with all these mortgages that are on the books of the banks, and it's really at ground zero of the credit freeze. Now, what's interesting to note is that there have been some banks that never wrote a subprime mortgage and did all the normal underwriting procedures, that a bank should do, as opposed to, just giving out money to anyone. These banks' assets that generally have good mortgages, have all been lumped into the group of the bad mortgages, the toxic assets. So in other words, there's a lot of assets out there that are being deemed as toxic, even though they're really not, because a lot of people are making payments on their mortgages. And just like, again, your car was going to be deemed an old car and so forth, and not worth as much because it's grouped into one category. 90% of the mortgages out there are being paid. Now, the easing of these rules are going to allow the banks to value the assets more favorably, and not rely so much on market forces. So it'll increase their value, it'll increase their capital structure. So it's really a plus for the banks. These are the type of things that we help you learn in our courses, and are really important in terms of what's going on and how it will affect various things that affect your life. So don't wait, get in a course, get educated, get to www.mywealth.com.
So another really interesting facet that's going on here in regards to the mark-to-market being eased and how it intertwines with the TALF program. which is the Term Asset-Backed Securities Loan Facility, in which the Treasury is going to loan money to investors in order to buy these toxic assets off the books of the banks to get them going again. And it might just be an example of where Washington starts doing too much, because now you have that program interfering with this program, and all of a sudden there's just another level of controversy in terms of how these assets will be priced. So these are the things that you want to look out for, and these are the things, again, we help you do, and really making certain that you have a broad understanding, which we help you do in our currency course, and of course in our investing course, where we help you analyze companies in terms of stocks to buy, and then or whether it be with ETFs and just having a diversified managed portfolio where you're looking out for your downside and also looking to achieve a high rate of return as well. And that's what we're all about here at MyWealth. Again, I'm Bob O'Brien. I'm one of the senior instructors with the courses. I look forward to seeing you in the course, and have an excellent weekend.